So one other housekeeping item is please use the chat to post any questions. We will be keeping track of them throughout the presentation. We'll also have a Q&A period at the end to address any questions that aren't addressed through Bob's presentation. So yeah, definitely make use of the chat. So my name's Rachel. I work in the financial aid office, and I'm here today with Lisa Simpson and Judy Merriman, who are also in the financial aid office. And then we also have Jason, the treasurer of the Graduate Student Council, who will speak in just a moment. We're very happy to have Robert Underwood with us today to give an informative presentation about graduate student taxes. So I'm going to hand it over to Jason. Jason's going to speak a little bit about the GSC, and then we'll get started.
Thank you very much, Rachel. I apologize to everyone. My webcam is kind of funky, so I'll just be speaking. But I just want to give a quick shout out. We have our election for the Student Council coming on the first Wednesday of April, so not too long. And while I've had a great time serving as the treasurer and helping to coordinate this type of programming and others, I'm unfortunately going to graduate soon. So I'll be stepping down, and I would implore you, if you're interested in getting more involved with student government, or you're just interested in learning more about kind of administrative background and skills, it's been a pleasure to work with Rachel, Lisa, and Judy. So if you like the content they've been putting out, I would implore you to maybe consider running for treasurer or one of the other open positions you might have at our election. So if you have any more questions, you can feel free to shoot me an email, which I'll drop in the chat. And thank you, Rob, for taking time out of your day to present for us.
Sure. Well, first off, congratulations on your coming graduation. Best wishes to you and your career and so forth. Rachel, thank you for having me, and Lisa as well. I'm going to have a presentation today, and sort of what we're talking about here is Taxation 101. Try and get through it as quickly as we can so that we can answer all your questions, and we'll stay on board until everyone has their questions answered. No problem there. And if in the event you discover that at the wee hours of the morning, which happened the other day, I got an email the other day from an international student at 1:30 in the morning asking me a question. Send me an email. There's my email address at the bottom of the screen, r@rcn.com. Feel free to send me an email, and you can certainly I will certainly get back to you as soon as possible and begin a dialogue to hopefully solve your problem or question that you might have. So keep that in mind, even if it's beyond today's presentation. All right, let's move on to the next slide. All right, basically, here's what we're going to discuss today. We're going to talk about your filing requirements in terms of your taxation, what's reportable income, the tax forms. We'll familiarize you with some tax forms. We'll talk about estimated tax payments, tax credits, student loan interest, state and local taxes, and then we'll get into our Q&A. But basically, for those of you who have never filed an income tax return, don't be anxious about it. Don't be intimidated by the process. It's pretty straightforward. It can get complicated if your life is complicated, so to speak, in terms of being involved in a lot of different activities. But I suspect at this point in your career, things are pretty simple. So the return is going to be pretty simple as well. So keep that in mind. Basically, there's two taxing authorities you have to keep in mind. There is the taxing authority at the federal level, and that is the Internal Revenue Service, which is the agency that has been charged with the responsibility of enforcing the tax laws and getting taxpayers to file their tax returns. Keep in mind the tax system, both at the federal and state levels, it's a voluntary system. You basically, at the end of each tax year, on or before April 15th of the following tax year, you will prepare an income tax return if you have income to report and taxes to pay, and you will volunteer that information to the government. But it's not totally voluntary in a sense that there are some checks and balances, which we'll talk about later on with regard to sort of keeping everybody honest, so to speak. But the income that you generate or earn during the course of the year will be reflected on your relevant federal and state income tax returns. So you have the IRS at the federal level, and then locally here in Massachusetts, we have what is known as the Massachusetts Department of Revenue that is charged with the same task in terms of seeing to it that people file appropriate tax returns. Nowadays, everybody is using some type of automated tax preparation software. The most popular these days is a product called TurboTax. There are many other products out in the marketplace. And basically, in the case of TurboTax, they do offer the use of that software as I understand it, free of charge. I mean, in my case, where I'm in the business of preparing income tax returns, I have a professional software that I have licensed that I use each and every year and have become familiar with over these past number of years. So in terms of the intricacies of using TurboTax, it's all menu driven. It'll walk you through the process. Obviously, what you have to keep in mind is for you to get a perfect or correct or accurate result will depend strictly on how accurate you are in terms of inputting the information into the system and responding to the questions that are being asked of you. Of course, the questions that are being asked of you are there for a particular reason from a standpoint of directing you where you need to go within the software so that the end result is, again, accurate and correct. So if you use TurboTax, there's other software called Tax Act and a few others I'm sure out there. And I'm going to refer you to a link later on with regard to a free service that is offered by the Internal Revenue Service. So, there are many, many options available to you. So all I can say is when you go through the process, simply take your time, read the question completely, and make sure you totally understand what is being asked of you. And not that it would be a fatal mistake from a standpoint of moving forward in the process, but you can always go back, make changes before you finalize the preparation of your return. So just be cautious along the way. And again, as I said, your tax situation at this point in time in your career is, I would say, probably very simple, unsophisticated, and you'll probably get through the process very quickly and easily from that standpoint. All right, let's move on to the next page. Let's talk about filing requirements and who's required to file. For federal income tax purposes, basically we're talking about US citizens and those individuals who are deemed to be resident alien taxpayers will be filing Form 1040. There was a point in time where there were other forms that could be filed, simpler forms, Form 1040EZ, you might have heard of, or 1040 A, which were sort of modified forms. Right now, beginning within the last couple of years, there is one single federal income tax form that is filed, and it's Form 1040. So there are no other forms that you could potentially file. So keep that in mind. And that's the software will produce the appropriate form of forms that you need to file. So when you talk about filing, there are thresholds that have to be exceeded, or if exceeded, would require that you file an income tax return. So for 2021 tax year, and when we talk about a tax year for individuals like you and I, we operate on what is known as a calendar year. Calendar year obviously begins January 1st, ends on December 31st. So whatever income that you earn within that window, that time frame, is reportable on that particular calendar year's return. So typically we're considered cash basis taxpayers, and as a cash basis taxpayer, we only report the income that we receive or constructively receive. So that's what's reported within that time frame. A lot of time people will ask me, well, I worked at the end of the year, but I didn't get paid until the next year. Is that income reported on the previous year or the year in which I receive it? And in the case of a cash basis taxpayer, it's always within the year that you receive it. So just keep that in mind. And we'll talk about the different forms that you might be receiving that would reflect your income momentarily. So with regard to filing an income tax return for 2021, if you are a single taxpayer and you're under the age of 65, the threshold is $12,550. So if your income is less than that, after you've gone through the process of determining what your income is, maybe some wages, maybe some interest income, some dividend income. If it comes under that threshold, if you're a single taxpayer and under age 65, you do not have to file an income tax return. You have no obligation to file the return and report that income because you're under that threshold. Next filing status is married filing jointly. And if you are under age 65, that threshold increases to $25,100. And obviously, as you can see, the initial threshold of $12,550 is now doubled. For obvious reasons, there are now two taxpayers involved in terms of filing a return. So that threshold doubles. There are other filing statuses which aren't probably going to be encountered in this environment, where if you were in fact married but you're filing separately, that threshold is $5, and there are reasons for that. The next threshold for head of household taxpayers is increased a bit, and a head of household basically is a taxpayer who maintains a household for a dependent, typically maybe a single parent with a child. That threshold increases to $18,800. And then the last item, single individual who is a dependent of another taxpayer. That's obvious from a standpoint of maybe a child who may have some income that has to be reported, but that's probably unlikely in this particular case. One thing to keep in mind, many of you may have encountered over the years, possibly in recent years, is if you had a part-time job. And if you had a part-time job, at the end of the year, your employer would have given you a W-2 form. And on that W-2 form, and we will look at one shortly, will be the amount of income you earned, and also if there was any income taxes taken out of your pay. What I want you to keep in mind is this. For example, if you were a single taxpayer in, let's say, in a part-time job, you earned $5,000, and your employer withheld a couple of $100 from your paycheck, federal income taxes, let's say, and state for that matter. So if you had some withholding and you earned less than $12,550, you wouldn't have to file an income tax return. But the fact is that withholding, that federal income taxes, let's assume a couple of $100 from that $5,000 you earned was taken out of your pay. The IRS is not going to refund that money to you. You will have to file an income tax return, even though you're not legally obligated to. And when you file that income tax return, you're going to disclose the income that you earned, $5,000, and you're going to reflect the income tax on $5,000, which is zero. And then we're going to deduct from that zero what you paid in, the $200, and you would be entitled to that refund. So the government isn't keeping an eye on this that closely from a standpoint of saying, oh yeah, little Johnny Smith there worked, he doesn't owe an income tax, but he paid us $200. We need to refund that money. That's not going to happen. You have to file a return in order to get those funds back. So keep that in mind. So if you have had occasion where within, let's say, the last 3 years, if there's been a situation, a time where that has occurred within the last 3 years, you can go back and file a return and get that money back. I say 3 years, basically there's a statute of limitations that applies where after 3 years, the door closes. The door closes in that the IRS can't come after you and you can't go back to them to get your money back. So keep that in mind. So if you recall working a part-time job and having some taxes withheld, here's an opportunity to maybe get a little extra money in your pocket in terms of filing that return. All right, let's move on to the next slide. This slide here is dealing with what is known as the Kiddie Tax. And basically, the Kiddie Tax is a tax that was added a number of years ago to basically close a loophole in the federal tax statutes. And basically, it's focusing on income earned by children that may have possibly, the source of that income may have possibly been from their parents. The reason for the closing of this loophole is that for federal income tax purposes, we have a graduated tax system. And tax rates begin at 0 and they go all the way to 39%, 39.5%. So basically, with the graduated tax system, the more money you earn, the higher tax bracket you're going to be in. So wouldn't it be to your advantage to maybe shift income or assets to a child who might be in a lower tax bracket than the parent's tax bracket and save some income? So here comes the Kiddie Tax, and basically that window is closed as a result of the implementation of the Kiddie Tax. Now, the Kiddie Tax is calculated on a separate form, and it's Form 8615. So if you have an individual who is responsible to pay the Kiddie Tax, you'll prepare the calculation of your tax on Form 8615, and you will include that form with your Form 1040. I'm bringing this to mind because there's a possibility that this may apply to a small number of you, if any, but I have to bring this to your attention from a standpoint of making sure that this aspect is covered in the event you would be responsible for the Kiddie Tax. Briefly, basically, it applies to children under age 18 and certain other children described below with unearned income over $2,200. And when we talk about unearned income, what we're basically talking about is interest and dividends, generally speaking. That is considered or deemed to be unearned income. So if your parents maybe shifted some income, some assets to you that generated this unearned income, then it's possible this income would be subject to income tax at your parents' higher rate and not at your lower tax rate. So again, keep this in mind if that's a possibility. Now, who must file Form 8615? It must be filed by any child who meets all of the following conditions. The child had more than $2,200 of unearned income. The child is required to file a tax return. The child is either A, B, or C, was under the age of 18 at the end of 2021, was age 18 at the end of 2021 and didn't have earned income that was more than half of the child support. And then lastly, was a full-time student. Here's where this may apply. Was a full-time student at least age 19 and under age 24 at the end of 2021 and didn't have earned income that was more than half the child support. That final statement there, didn't have earned income that was more than half the child support. And basically what the government is looking at is here, if the individual had earned income being wages, let's say, employment income, compensation for services rendered, that's considered earned income. if that child's earned income was more than 1/2 of that child's support. And what do they mean by support? What that child needed to live on. Housing, clothing, food, et cetera, et cetera, et cetera. So in other words, if that child earned, let's say, $20,000, $30,000, that would certainly be enough earned income to support that individual. So that's where that would not apply from a standpoint of not having earned income that was more than half of the support. Because if the child didn't have any earned income, then chances are the child is being supported by the parent, okay? The last two, at least one of the child's parents was alive at the end of 2021 for obvious reasons. If neither were alive, then the kiddie tax wouldn't apply and the child doesn't have to file a joint return. So those rules are what apply. If you're using the tax software, these questions will be addressed in the process of preparing the return. The other thing to keep in mind, if it's likely that this might apply, you want to make sure you sort of coordinate things with your parents in terms of when they're filing, not that it's going to affect their return, but we just basically need to understand how these two interact. So just keep that in mind. Again, I suspect this may not apply to many of you, but I do have to bring this to your attention. All right, let's move on to the next slide. For non-resident taxpayers, they need to file a Form 1040 NR. That is Form 1040 non-resident returns. And basically, just for information purposes only, reporting requirements vary depending upon the individual source of income in tax treaties. I suspect we're not dealing with anyone in this forum today that would be considered a non-resident. If you are, you can certainly hang in here, because at some point it's possible that you may become a resident taxpayer for U.S. purposes. The filing options you have, I talked about, TurboTax, Tax Act, those types of products that are out there that you can use for purposes of filing a return. There is the link I referred to earlier with regard to filing via the Internal Revenue Service online service, which is free. And as you can see there, the service is free if your taxable income is less than $69,000. So I'm sure for many of you, that would be the case. So, take advantage of that. If it's beyond that, then there's a fee involved as well. So in the Commonwealth of Massachusetts, if you were to have to file a Massachusetts income tax return, you have that option as well on the Massachusetts side. So, seek those situations out where you can get these free services in terms of filing a return. We have due dates in terms of filing a return. Generally speaking, the due dates are April 15th. So 4.5 months after the 3.5 months, after the close of the calendar year, the initial due date for filing a return is typically April 15th. If it happens to fall on a weekend or on a holiday, then the date is moved up to the next business day. So if, for example, the 15th was on a Sunday, then the filing due date would be April 16th, that following Monday. And depending upon what state return you may have to file, generally speaking, everything falls into place unless there's some unique situation with regard to that state where there might be a later filing date. All right, next screen. Reportable income. In terms of reportable income, as a resident, as a U.S. resident, as a U.S. citizen, as a resident alien, you will report your income from your worldwide source of income. So regardless of where the income is earned, whether it be in the US or in a foreign country, that will be reported on your US income tax return. There are some exceptions with regard to foreign income, which we won't get into today, but basically there are a number of exceptions that could apply where some or all of that foreign income could potentially be exempt. But again, I don't see that being the case here today. Examples of reportable income, salaries. If you're working for an employer and earning a wage from that employer, you will typically receive from that employer a W-2 form at the end of the year, and we'll introduce you to that form momentarily. If you have any portion of your fellowship, scholarships, and grants that are taxable, need to be reported on your U.S. income tax return, and we'll get into that in greater detail. If you've earned bank interest or dividends from stocks, that will be reportable. If you have any investment income from maybe partnerships or other types of entities, that income would be reportable on your U.S. return. If you're receiving royalties, if you've received prizes and awards, those amounts reported as well. And then lastly, if you own any real estate and receiving rentals or selling real estate, the proceeds from the sale of that real estate would be taxable on your U.S. income tax return. All right, let's move to the next slide. All right, let's talk about scholarships, fellowships, grants, and awards in terms of what's taxable, what isn't taxable, and what you have to keep in mind. When we talk about scholarships, basically you're receiving those for the purposes of helping you with your studies. And obviously, if you're receiving fellowships, the underlying purpose behind that is to help you with regard to your research work. Now, the federal tax system is guided by the Internal Revenue Code. The Internal Revenue Code is the body of laws that basically give us the rules that we need to follow. And when we talk about scholarships, fellowships, grants, and awards, the taxation of these come under the control of Section 61 of the Internal Revenue Code. And what Section 61 of the Internal Revenue Code says is basically, except as otherwise provided in this subtitle, gross income means all income from whatever source derived. So basically, the tax code says all of your income is taxable income, regardless of what source it's been derived from. So basically, everything that you receive and earn and so forth would be considered income under Section 61. Fortunately, there are exceptions, and the exceptions follow in that there are a number of exceptions with regard to exempting some of this income from taxation. In the one section of the Internal Revenue Code that applies with regard to scholarships and fellowships is Section 117. And basically, Section 117 says gross income does not include any amount received as a qualified scholarship, which we'll discuss, by an individual who was a candidate for a degree at an educational organization. So basically, if you've received what is identified or defined as a qualified scholarship, that is not income. So the financial support and aid that you're receiving from the university, what we'll find out shortly is some portion of it is not taxable, potentially, and some portion of it is taxable, potentially, depending upon what type of support you are receiving from the university. All right, so let's move on and we can further define, next slide. And we can further define what's taxable and what's non-taxable. And the first being, it's not taxable if the following conditions are met. The individual is a candidate for a degree at an educational institution that maintains a regular faculty and curriculum and normally has a regular body enrolled in attendance at the place where it carries on its educational activities. Clearly, Harvard University is a facility that has a curriculum, and needless to say, if you're a candidate for a degree at Harvard University, you meet that criteria. And secondly, and not only do you have to be a candidate, but amounts you receive as a scholarship or fellowship grant are used for tuition and fees required for enrollment or attendance at the educational institution, or for fees, books, supplies, and equipment required for courses at the educational institution. Basically, if you these would be deemed or identified as qualified educational expenses. So if the support you're receiving from the university is to cover your qualified educational expenses, that support is not taxable to you. You don't have to report it. It's not income. It's exempt under Section 117 of the Internal Revenue Code. So that leads you to the next question, and what is taxable? So basically, if you are receiving amounts used for incidental expenses, such as room and board, optional equipment, and generally amounts received as payments for teaching, research, and other services required as a condition for receiving the scholarship or fellowship grant. In addition, any part of the scholarship or fellowship that represents a payment for services is taxable. So for many of you, the biggest item here that sticks out is that if you're receiving a stipend, and if you're receiving the stipend, and that stipend, as I understand it, is for the most part, it's a monthly stipend that you're receiving. And for the most part, those funds are provided to you, and you can do as you please with those from a standpoint of, but for the most part, the primary purpose behind that stipend is to help with your living expenses. So right out of the box, essentially, if you are receiving that stipend and it's not used for any qualified educational expenses, then it would be fully taxable and reported as income on your U.S. income tax return. So there it is in a nutshell in terms of what you're looking at from a standpoint of what's potentially reportable for income tax purposes. Next slide. Okay, let me refer you to, this is where you can get the guidance that you need with regard to determining exactly what portion of your overall financial aid is taxable. The IRS has a publication, and that publication is publication 970. If you like, I would suggest that you go onto the IRS website, and that's at irs.gov, G-O-V, irs.gov, and you can search for IRS Publication 970. Within that publication, there is a worksheet that you can use to arrive at that portion of your financial aid that's taxable for U.S. income tax purposes. So keep that in mind. Consider going to that worksheet and going through the process of entering the information. The worksheet, I think, contains maybe 7, 8, 9, 10 lines of input that you would enter, but the end result, if properly completed, the end result, you will arrive at what you would be reporting on your U.S. income tax return. Now, as I stated before, we talk about W-2 forms or reporting mechanisms that the IRS that are in place. And when I talk about reporting mechanisms, basically, for example, if you work for an employer, at the end of the year, you're going to get a W-2 form. Well, not only do you get a copy of that W-2 form, but guess who else gets a copy of it? The Internal Revenue Service. And for the most part, the Internal Revenue Service does a pretty good job of sort of keeping people honest if they have the means in which to keep people honest, so to speak. In other words, if, for example, and it's happened, I've seen it over the years where people have inadvertently omitted reporting income on their tax return and maybe omitted a W-2. Maybe they forgot that they worked a part-time job, did not include that income on their tax return. The IRS would get a copy of that W-2 and all of the W-2s that you received during the course of the year. And when you ultimately file your income tax return, the IRS will compare those W-2 forms that they received to what you reported as income on your return. And lo and behold, if you overlooked one of them, inadvertently overlooked one of them, you would ultimately, within maybe a year's time of after filing your return, you would get a notice from the IRS. Oh, by the way, you forgot to report some income. If you agree with us, this is the additional tax. Please pay by such and such a date to avoid any further interest and penalties. And obviously, you, as a result of getting that notification from the IRS, you realize that you did inadvertently overlook reporting that, you agree with them, and you basically sign off on it and send whatever balance due that you might owe the Internal Revenue Service for underreporting that. So again, if you're an employee and you're earning a wage, you'll get a W-2 at the end of the year. And that's going to be the source document that you would use in preparing your income tax return. It's possible that you may be earning other income that would be reported to you on a Form 1099 miscellaneous. And recently, there is a new form, also Form 1099 NEC. Basically, this is work that this is income that you that's reported to you that's for work, or not work, but basically services other than you being an employee of an employer. There's a Form 1042S, which is typically received by non-resident aliens, which I won't introduce you today, but that's another reporting form that is used. And then finally, it's possible you may get absolutely no document whatsoever in terms of what you have to report. And basically, that's going to happen here in the event you're receiving some type of stipend. The university is not required to report to you on any document whatsoever that goes to the Internal Revenue Service to identify what is taxable. That's the way the law has been designed. I'm not exactly sure why, but as it stands today, and as it stands for the past many, many years, this income that's ultimately taxable to you is not reportable to the IRS, nor are you informed of what portion of that income on any type of document. So again, like I said, I suggest that you go to that worksheet and go through the function of arriving at that calculation. For the most part, what the result you will end up with going through that worksheet is, again, if you are receiving that monthly stipend for your purposes of your living expenses, that is, for the most part, the amount of income that you would be reporting on your U.S. income tax return. So keep that in mind. Now, at the very bottom of the screen here, there's a little screenshot here of a very small portion of Form 1040. And basically, once you have arrived at the amount that is taxable of that stipend, you are going to report it on line 1 of Form 1040. And as you can see to the left of that amount, there is a notation SCH. SCH is an abbreviation for scholarship, and basically what it's doing is identifying that the amount on line 1 or a portion of that amount on line 1 is taxable income from a scholarship, fellowship, or grant. Now, the tax software that you use will insert that notation to the left of the amount on line 1 if you've properly entered this into the tax software. So at some point along the way, and I wish I could be more specific, if you are filing an income tax return and going through the process, let's say with TurboTax, you will be asked if you've received, at some point along the way, you will be asked if you received any taxable scholarships or fellowships. And if you have, you are going to enter into that portion of the menu, and you're going to identify that form, that amount of money as a taxable wage or a taxable scholarship. And when preparing the final tax return, that notation will appear to the left of that amount. If it does not, then you did something incorrectly. So just keep that in mind. That's how it should be reflected. It's possible you could enter that amount on line 1, but without that notation, it's possible that the return you're preparing is inaccurate. So please, keep that in mind and make sure that notation is there if in fact it needs to be. All right, next slide. All right, this here is a very poor example of a W-2 form, but basically what we have here is an example of a W-2 form that was issued by the university to an employee. And when you talk about a W-2 form, they come in all different sizes, shapes, and colors, but at the end of the day, there is essentially information on that W-2 form that is consistent from one W-2 to the next. For example, on line 1 of the W-2 form, it's telling us what we earned in wages. Line 2, box 2, I'm sorry, it's identifying the amount of federal income tax that was taken from those wages. Line 17 is identifying the amount of state income taxes. So if you have a W-2 from Harvard or from anywhere else, those same boxes are going to have that same information with regard to disclosure. So this W-2 form, I'm bringing it to your attention because I see it as a source document that you will use in the preparation of your tax return. So if you've worked if you've received the W-2 form, you will at some point during the process input the information from this form into the tax software to prepare your return. So this is an example of a source document that if you haven't received and you think you should have received the form, I would reach out to the employer and ask why you may not have received it, may have been mailed to an incorrect address or whatever the case may be. All right, next slide. All right, here is an example of Form 1040. And this is for 2019. The form hasn't changed that dramatically with regard to what it's looked like between 2019 and 2021. For the most part, it's the same. And what you see there is I've highlighted on line 1 with that red arrow, the notation of SEC. This is a Form 1040 that I prepared on using my tax software, and this is how it presents itself. Basically, the amount I entered into the system was a $33,600 stipend amount that is taxed. It's identified as SCH on line 1, and within the return, there's a statement within the return just identifying the source of that money, that being from Harvard University. So for this taxpayer, John Doe, this is the only source of income for this taxpayer. So as you can see, we total that amount on line 7B, we total it again on line 8B, and then on line 11A, we have this amount of $12,200. And that amount is subtracted from the amount on line 8B. Now that amount on line 11A, if this was a 2021 return, the amount on line 11A would be $12,550. And if you recall, that was the threshold that if you exceeded, you would have to file a return and pay a federal income tax. Back in 2019, the threshold was $12,200. Basically, the tax law indexes these thresholds tied to inflation, and they typically creep up $100 or $2 from one year to the next. So from 2019, it went from $12,200 for a single taxpayer up to $12,550 today. So this particular taxpayer now has, after this amount, and this amount is referred to as a standard deduction. We as federal taxpayers get standard deductions. We can deduct from our income a standard deduction, or if our itemized deductions are greater, we can then deduct the greater amount. I'm not going to get into itemized deductions because I suspect most of us would just simply qualify for the standard deduction. So this taxpayer now has what is known as on line 11B, taxable income of $21,400. Let's go to the next slide. Now, back in 2019, the tax on that amount of money, $21,400, is $2,377. That's an exact calculation. So that was a student that received, has taxable financial aid of $33,000 and change, and that individual's tax liability based upon that amount of income is roughly $2,400. Now, for 2021 tax purposes, that's about what the tax would be. It might be slightly higher, but the fact is, if you have a $33,000 stipend that is taxable, your tax bill for 2021 is going to be in the neighborhood of $2,500. That's an actual amount. So just to give you an idea of what you're looking at, if that's the case. And that $33,000 would roughly represent somewhere in the neighborhood of a year's stipend that one would receive. So that's what the tax bill would be for the most part. Obviously, you need to go through the process to arrive at, needless to say, the correct amount. The one other item that I want to bring to your attention is that section there with the red arrow, which refers to basically your ability to provide on your tax return banking information. And if you are entitled to a refund, you would make sense for you to include that banking information as opposed to waiting for a check. And let me just backpedal for a minute. In terms of filing the return, you can file a paper tax return. You can go through the process of entering the information in the tax software, and you can ask that a paper return be produced. I suggest that you file an electronic return. You e-file the return, because what it will do is it will expedite the process. So if you are entitled to a refund, it's likely you would see that refund in maybe a week or two's time if you file electronically, number one, and if you ask that that refund be deposited directly into a bank account. Needless to say, until you get that bank deposit electronically, make sure you keep that account open, because if you happen to close it inadvertently, what's going to end up happening is it's going to be weeks, if not months, before you're going to see that refund or be able to communicate with the IRS and ask where it might be. So keep that in mind. And obviously, for many of you, I'm sure, we're all in tune with regard to doing things electronically. So file the return electronically and ask that that refund be deposited directly to a bank account. All right, next slide. All right, now, With regard to the taxability of that financial aid, the university does not and is not required to withhold any taxes on that amount of money. You are now responsible to send to the Internal Revenue Service and or the state the appropriate amount that you believe will be owed on that money come the end of the year. So during the course of the year, you're going to get a monthly stipend. It's taxable. No taxes are going to be taken out of it. The onus is on you to make sure that you send the government what it needs to get, or an estimate of what you believe you will owe them come the end of the year. And this is done by way of paying what we call quarterly estimated taxes. The rules regarding the requirement to file quarterly estimated taxes are as follows. For federal and state income tax purposes, all taxpayers who expect to owe $1,000 and $400 respectively are required to file an estimated tax. So if we refer back to John Doe, basically his tax bill was roughly $2,400. So under that scenario, John Doe should have been paying to the Internal Revenue Service $600, 4 quarterly installments of $600 each to cover his tax bill of roughly $2,400. And those installments are due on April 15th of the current tax year, June 15th of the current tax year, September 15th of the current tax year, and then the last installment due on January 15th of the following tax year. So John Doe should have sent in quarterly installments equaling roughly what he anticipates owing the government, so that when he physically files his Form 1040 with the Internal Revenue Service, he will show the liability of $2,400, and then within the return on that backside on page 2, he will make an indication, a notation of the fact that the $600, 4 $600 installments were sent to the government, and then his obligation of paying that tax has been fulfilled. If you feel that you want to wait until the end of the year when you file your tax return, you can do that, but there are consequences. And the consequences are you'll be subject to interest and penalties. On a tax bill of roughly $2,400, I can say it's not a monumental amount of money. It's not like the government says, yeah, you owe us $2,400 in taxes and you owe us now another $1,000 in interest and penalties. It wouldn't be that high. If anything, it'd probably be in the neighborhood of a couple of $100 at best. Needless to say, that couple of $100 in penalties and interest certainly better in your pocket than the government's pocket. So I implore you to, if you have to file an estimated tax, be sure to do so. Now, there were rules with regard to avoiding a penalty, and they are as follows. In order to avoid penalties for underpaying of your estimated tax, the total of your estimated payments for the current year must be greater than 90% of the current year's tax liability. So John Doe owed roughly $2,400. If he paid in 90% of the $2,400 during the course of the year, he wouldn't be penalized. The other safe harbor is you can pay in 100% of your prior year's tax liability. So if you had a tax liability in the prior year of $1,000, if John Doe had a tax liability in the prior year of $1,000, John Doe could just send in $1,000, and then when he files his return in April, he would send in the balance due of roughly $1,400. So though that's the safe harbor that you can fall into with regard to paying your estimated taxes. Regardless of whether you pay estimated taxes during the year or at the end of the year, your tax bill must be paid in full by April 15th following the close of the tax year. So if you didn't pay any estimates, You need to file your return by April 15th, and you need to pay what you owe by April 15th. If you don't pay what you owe by April 15th, guess what? Penalties and interest will begin to toll, so to speak, and you're going to end up sending the government more money than you need to. Now, as far as paying these quarterly installments, those can be paid electronically for federal tax purposes. You can go to that link there and pay them there. If you owe an obligation to Massachusetts, you would go to that link and pay your installments there as well, all electronically. As far as the government keeping track of these funds on your behalf, they do a very, very, very good job. So obviously, if you pay these amounts electronically, you will identify yourself with regard to your name, address, social security number, and those amounts will be maintained in your file with the government. And basically, as you pay them during the course of the year, the government will be collecting this money from you. They don't know exactly what you owe or what you will owe or whether you're overpaying or not. So at the end of the year, when you file your tax return, you will disclose on your return what you paid during the course of the year. And obviously, if your identification of what you paid equals what the government has received, there's going to be no issue. If you said the government, you sent in $10,000 and they only have a record of receiving $5,000, basically, obviously, the return's going to get kicked out and there's going to be a question as to why that is the case. Either you're mistaken or the government's mistaken, and you'll need to obviously clear that up. If you're concerned about paying these amounts electronically, you can always send either the IRS or the applicable state a check. Typically, when you send in a check, you will identify yourself as to who you are, provide with the social security number and all of that, and then that amount will be applied to your account. All right, next slide. Just briefly, with regard to educational tax credits, there are two primary educational tax credits available. The first is the American Opportunity Credit. Forget about it. It's only available to undergraduate students. If anyone took advantage of that credit, there's a very good likelihood it was your parents when they filed their tax return. The other credit that may be available to you is the Lifetime Learning Credit. And basically, the credit is available for those who have paid qualified educational expenses for higher education. And those qualified educational expenses include tuition and related expenses required for enrollment in a course at an eligible educational institution. The maximum credit that you can receive is $2,000, and that's based upon the first $10,000 that you pay in qualified educational expenses. If you did not pay for any qualified educational expenses, then the credit would not be available to you. So just keep that in mind, all right? That's educational tax credits. Next slide. Student loan interest. If you are paying off any student loans, that student loan interest is deductible, and it's the lesser of what you paid, or $2,500 in terms of student loan interest. So there is a deduction on Form 1040 that allows you to reduce your income by $2,500. So if we go back to that Form 1040, we would get a deduction, and in the case of John Doe, his income of roughly $33,000, if he paid $2,500 in student loan interest, would be reduced by that amount. That earlier tax credit, the lifetime educational credit, it's a tax credit and it's a reduction on your tax bill. So if John Doe was able to take advantage of that tax credit, if you recall, the maximum tax credit, if you recall, his tax liability was roughly $2,300. As a tax credit is a dollar for dollar reduction in your tax. So if he was entitled to the maximum tax credit, the lifetime learning credit of $2,000, John Doe's tax bill after the credit would be roughly 300 and some odd dollars. So as you can see, tax credits are certainly worth more than tax deductions. So just keep that in mind if that applies. All right, next slide. Suppose basically, if, for example, we'll talk about Massachusetts briefly, if you are deemed to be a permanent resident in Massachusetts, then you would be required to file a Massachusetts income tax return. And basically, the income as reported on your federal return would be taxed in Massachusetts. So keep that in mind when using the tax software, whether it be TurboTax or any other software. Typically, the state income tax return that you would be responsible for filing will be produced, because for the most part, once you've completed your federal income tax return, for the most part, your state income tax return will be produced as well. So keep that in mind from that standpoint. So you'll go through the process with the tax software, and at the end of the process, if you're responsible for filing a Massachusetts return, that return will be produced for you. Next slide. Okay, now with regard to the point I want to make here is with regard to your status in Massachusetts, you would be responsible to file a Massachusetts return if you have what would be deemed a permanent place of abode in Massachusetts. For those of you who might be in university housing or dorms or whatever you want to call that space, that wouldn't be considered a dormitory. I mean, a permanent place of abode for Massachusetts tax purposes. And if that's the case, then you may not be responsible for any U.S. Massachusetts income tax return at all if you do not have a permanent place of abode. So keep that in mind for those of you who are in that typical situation where if you're in dormitory or campus space, you may not file a mass return. It won't be necessary. In the last slide, it's possible you may be coming in from another state, and it's possible that you may have to file multi-state returns. So if you were a resident in another state for a portion of the year and become a resident in Massachusetts for the latter half of the year, it's possible you may have to file part year returns for both. For example, California, if you're coming in from California and you may have income that has to be reported there for that period of time, you may have to file a part year return in California and then a part year return in Massachusetts. So just keep that in mind. Again, the tax software will help you in that regard, and during the process of inputting the data into the tax software, this specific question may be asked with regard to you being a part year resident in one state over another. Then you will walk you through the process of filing that return. And having said that, let's get to some questions.
Lisa, are you all set?
Yes, yeah, I'm all set. Sorry, I couldn't get my unmute off. So we had a couple of questions about when students receive income for a reimbursement for like a research expense. How does the university report that to them? What form is it on? And is it taxable if it's a reimbursement?
I think it might come out to the individual. It's going to be taxable, and I think it's going to come out to the individual on a 1099 miscellaneous form. But as I referred to the worksheet in the IRS Publication 970, you're going to include that on there, and if it's excludable, it'll be so noted. But the fact is, My understanding is, if you recall, if we go back to that, we don't need to go back to that slide, but basically it's taxable if the amounts are used for incidental expenses such as room and board, travel. So, yeah, right there, exactly. When you talk about, these amounts are taxable if they are used for travel, and if it's for research, it's taxable as well. So I'm going to say that those amounts would be taxable and should show up on line 1 of Form 1040.
A question about student is a U.S. citizen, but just moved back to the United States, and she wants to know if she's considered a U.S. resident. She lives in the residence halls. I mean, if she has a U.S. nationality and passport, she is a U.S. resident and is required to file taxes, correct?
Yeah, I mean, if the individual is a U.S. citizen, unless they've denounced their citizenship, they'll be forever a U.S. citizen and would have to file a U.S. income tax return.
And if they're living in the dorms or the residence halls, the GSAS dorms, then I think you talked about this a little bit earlier, but what does that do to their filing for state taxes? And if they hadn't lived in a state previously to coming to GSAS, what do they do?
Well, I mean, if it's possible that with regard to, for state filing purposes, if they're deemed to not have a permanent place of abode in Massachusetts, then if there's any income that would be reported, not reported, and that being, for example, a stipend, that wouldn't necessarily have to be reported on a Massachusetts return. They may have other sources of income that would have to be, and it's possible those other sources of income may be under the threshold. And if that's the case, for Massachusetts purposes, which is $8,000, then they wouldn't have to file a Massachusetts return at all. Again, I would rely on the use of the tax software to help them get through that process to understand it further.
Okay, great. And a couple of questions about reporting stipend income. Is students not understanding the university, as you said, doesn't issue them and is not required to issue them a tax document for stipend. And how do they determine how much money they should be entering on that tax form?
Well, that all goes back to, again, that worksheet that I referred to in IRS Publication 970. They want to go through that process of using that worksheet to arrive at what would be, of all of the financial aid and support that they're receiving from the university, they're going to start with that, and then they're going to back out from that, that portion of that aid that would be considered for qualified educational expenses, and what's remaining would be their taxable amount. For the most part, and I can't say this unequivocally, for the most part, the monthly stipend they're receiving, for the most part, is going to be what is taxable.
Okay.
But I encourage going through that worksheet in that publication to arrive at what would be an accurate number. But I think at the end of the exercise, it's going to be equal to the amount of that monthly stipend.
Okay, and students that are receiving, we have a number of students that are receiving both, a stipend, but they're also receiving a W-2 for, say, a teaching fellowship type position. So
Yep.
if you get a W-2, you should still go through that worksheet because you might also have stipend income that's not reported on that W-2. So
No, I mean, the W-2, no, the W-2 stands on its own.
Okay.
In
But
using that worksheet,
shows
again,
stipend.
I'm sorry?
The W-2 won't show the stipend.
No, not at all, no. Nope,
So
it's separated.
Yeah, so if a student has, income, if they're issued a W-2, but they have other stipend income, they should still go through that exercise with the worksheet in Publication 970?
Exactly, absolutely. But they can ignore the W-2 wage is not considered any financial aid or support, and it doesn't come into play when completing that worksheet. That's separate and distinct from the aid that the university is providing.
Okay. This question about the 1098T form, and that's the form that the university issues for when a student receives or pays tuition. Maybe you can clarify that exactly what the 1098T is. But this student wants to know, she said there's a very large number in box 5, and she can't find anywhere in the tax forms what she needs to do with that. So can you help us understand the 1098T and how a student works with that?
Well, basically, the 1098T is required to be issued by the university. Box 1, the two boxes, one of which you've referred to, box 5. Box 1 identifies what the student has paid in qualified educational expenses in that tax year. Box 5 represents the scholarships and awards that were given to the student. Now, basically, for the most part, the 1098T is used for purposes of determining any tax credits that might be available to the student. That being either the, in the case of our student body here, we're talking about the lifetime learning credit. For the most part, if, for example, you have an amount of scholarships, if you have, qualified educational expenses that are pretty much covered by the scholarships that are being awarded by the university, you have no credit available to you because you haven't paid any qualified educational expenses. Those qualified educational expenses were covered by your scholarships and awards. So the lifetime learning credit would not be available for that particular individual.
Okay.
It has, the 1098T has nothing to do with anything you're reporting as income on your tax return.
Let's see. Does Harvard provide 1099 miscellaneous forms? I suppose they would if there is some sort of miscellaneous income. What shows up on the 1099, Bob?
I think for the most part, what I've seen is maybe money for travel.
Okay.
In research, they'll issue a 1099 miscellaneous.
Mm-hmm. Okay.
And as we discovered, that would be taxable.
Okay. Wondering what form Harvard gives us for reporting graduate stipend income. And as we mentioned before, the university isn't required to issue anything, but students can view the amount of stipend they've received in PeopleSoft. All of your checks are listed in PeopleSoft, and you can see the amount of stipend that you've received in any given tax year.
Yeah, exactly. I mean, what I've seen over the years is a document that's been produced, and I believe what your indication that it's something that's been produced by way of PeopleSoft. I will often ask a student if you could produce that year-end pay stub or wage stub or whatever you want to call it. That will provide a year-to-date amount, and it's typically identified, I believe, as domestic stipend. Mm-hmm. Yep. On that particular form. And
so that would, so that'd be the last pay stub that is available in any given calendar year will have the year-to-date totals on that.
Exactly. Yep.
Okay, great. I'm a tax resident through the substantial presence test, but I received a 1042S since I was on fellowship for the first half of last year. Am I required to file this? And if so, do I input the gross income or just the taxable income from the form?
All right, well, this is for a non-resident. The individual will file a non-resident return. You're going to include the gross amount. And if there is treaty provisions that apply, the software will pick that up and decrease that income by the treaty exemption. If that individual is still on board here, basically what we're talking about is using the tax software that the university provides to non-resident students, and that is Sprint Tax. So you would want to notify the international office, if you haven't already, and get an authorization code to use the Sprint Tax software for purposes of filing a non-resident return.
Thanks. A couple of other questions here about non-resident alien taxes. And I just want to let people know that last week we did a tax session specifically for non-resident taxes that you can access on the GSAS website. And also, if you have questions about non-resident tax filing, you can reach out to the international office at Harvard. I became a tax resident last year, but I still received a 1042-S. This year, I received a W-2, but it only accounts for the second half of 2001. When I got transferred from my program or lab, is the other half likely in a 1042-S or lost or nowhere? How do I report?
Well, this is something we discussed last week with regard to the university, not necessarily you identifying your tax status in maybe a timely fashion. If I understand the question correctly, it's possible that in through the Glacier system that the university wants students to update the university in terms of their status. If the individual believes that they were a resident for the entire year, a resident alien for the entire year, then you would file a Form 1040. So that sort of needs to be cleared up. If they're is that individual available to interact here?
I'm going to just send this individual to the international office. I think that's probably the best place for them to take this question.
Yeah, exactly. I mean, if they were misclassified as being a non-resident when in fact they should be considered a resident, there's a way to work around that in terms of filing a return. So you may want to speak with the international office and get that cleared up. And if you need any further help, send me an email and I'll be happy to try and point you in the right direction.
Great. I've read that scholarship fellowship funds should be taxed to the extent that they are in the period in which the funds are intended to go to qualified educational expenses. So if I receive funds in 2001, but intended to support research in 2002, in which year do I pay tax on it?
So funds were received in 2001 for use in 2022.
That's what he said.
That's the question.
Yeah.
That's a good question. I would say if they were earmarked for qualified educational expenses, then they would be exempt from tax in 2021.
Okay. Given the work from home situation, if we worked remotely in Massachusetts for a company located in another state, do we need to file state tax returns for the other state?
That's been under debate since this whole COVID situation. Needless to say, the other state may likely want you to report those taxes in that state. So it's another state, you're physically in Massachusetts, working for a company in another state. It's likely that you would owe taxes in that other state. If that other state was that your residence at one point in time? That's a question to be asked.
Yeah, we don't know that information.
Yeah.
If it was, does that make a difference?
Likely, because that's that state would assume that those were wages earned in that state, even though working in another state. It's possible that that income could be reported in both states, but getting a tax credit for the taxes paid in the other jurisdiction could come into play so as to avoid double taxation.
Okay. And here's a question that's somewhat connected to that. I made more than $20,000 in New York City during my job until August 2021, and then moved to Massachusetts, where I made only $3,200 only during the rest of the year and lived in a graduate dorm. Do I still need to file Massachusetts state taxes?
I would say no, because you're under the threshold. You've got a part year New York's return to file.
Okay.
No question there. But as far as if you're under the $8,000 threshold, then a Massachusetts return wouldn't be required.
Okay. If the stipend that we effectively receive already has graduate student union dues subtracted, should we report that subtracted amount or the original, adding back to the union due amount? How does the union dues, are those taxable, or do you deduct that from the amount that you claim?
Well, the question here is, are the union dues considered a qualified educational expense? That's what it really comes down to. If it's considered a qualified educational expense and it's required for enrollment, then I would say it's a it would be considered a qualified educational expense and not taxable. I've never encountered that. I mean, that's something new. Is that the case at the university? Didn't
Yeah,
segments
it is a new thing. Yeah.
unionize?
Yeah.
All right, but I mean, I would, if it's required, if those union dues are required for enrollment, then I would say it's a qualified educational expense, but I don't think it would be considered as such.
Well, not to the best of my knowledge, not everyone is considered a part of the union, and so not everyone has union dues taken from their pay.
Yeah.
So if those conditions are true, you would say that it would not be a qualified education?
It's not a qualified educational expense and it would be taxable, yeah.
Okay. I receive a PhD stipend and have spent a significant amount of money on books for my courses. Is there a way to receive tax deduction for the books that I purchased?
Well, that again goes back to it being a qualified educational expense. If it's considered a qualified educational expense, then the outlay of that money would reduce your taxable award.
Okay. When I filed my taxes last year, I received a refund in both my federal and state taxes, but this year I owe a significant amount of federal taxes and some in my state taxes. My situation has not changed since last year, roughly same income status. Why am I having to pay so much more?
Without having more information, I really can't answer that. I mean, it's all dependent upon, what was paid in the previous year. I mean, obviously, if there were taxes withheld from some resource that was sufficient to cover your liability and beyond, then you would be getting a refund. There are not enough facts here for me to give you a legitimate answer, to tell you the truth. If you want to send me an email and we can delve into it a little greater, I'd be more than happy to oblige.
Great, thanks, Bob.
Yep.
One more question. I'm currently living in California, but I'm receiving a stipend money from Harvard. Do I need to report the stipend as Massachusetts income, or do they report this in California state return?
Well, that's a very, very good question. And I would think that there's a possibility that it would have to be reported on a California state return, unless that particular income by law in California made it exempt. For the most part, most state tax returns, when you file a state tax return, the income reported on a state income tax return is from the federal return. A lot of state returns, and I can't speak to California. I've prepared California returns, but the bottom line is this. In preparing a state return, the starting point in terms of the income reported on that state return is the federal income reported on the federal income tax return. And then from there, adjustments are made. So it's possible that if you start with the federal income that you're reporting, if it's possible that there might be an adjustment or a deduction against that amount for those other sources of income. For example, this item, I can't speak to that directly. I'm not aware of it in California.
Okay. This is a sort of a long question, but I think what the person is asking is if they received a grant towards tuition for less than the amount that they were charged tuition, could they deduct the amount of stipend that they received? Could they reduce that amount because that went to pay tuition? Does it work that way? Is this covered in that publication 970 you mentioned?
Yeah, I mean, you would go through the process of completing that worksheet in 970, exactly.
Okay, all right.
Because a portion of that taxable stipend, it basically what I think what is being asked here is a portion of that stipend is being used for qualified educational expenses.
Okay.
And if that's the case, then it would be reduced. I would agree.
Okay. Let's see. Looks like I've gotten somebody's question wrong. Jacob, I'm not sure which question it was. If you can post that again, specifically what I got wrong, I will ask Bob. I think we've got, if I missed anyone's question, we still have a couple minutes left. But if not, if there's something that we got wrong or overlooked, you can reach out to Robert Underwood at runder@rcn.com and he can help you navigate these situations. Here's a student. I graduated last year. Whoops. I graduated last year. I moved to a postdoc position. At the same time, I moved from a non-resident to a resident alien. Do I need to file as a dual status or can I file as a resident? That's where does he go for an answer for that, Bob?
Yeah, well, I mean, it all boils down to when his residency began. If it was deemed to begin effective the first of the year, then he'd file a resident return. If we're deemed to begin somewhere other than the first of the year, then he would file as a dual resident.
Okay. Okay.
So the $64,000 question there is, when was his residence? When did he deem to begin as a resident alien? When did that commence?
Okay.
It could have been January 1st. If other than January 1st, then he would be a dual status.
Okay. And does fellowship income always count as unearned for the Kiddie tax, even if it goes in line 1 on the 1040 wages, tips, etc.?
My understanding is it's kind of crazy with regard to a taxable stipend. For purposes of Kiddie tax, my understanding, it's deemed to be unearned income. For purposes of qualifying as earned income, when it comes to making contributions to an IRA, it's considered earned income. So it's sort of like a chameleon. It changes its color depending upon where it's being where it lies, so to speak. But that's my current understanding. If for Kiddie tax purposes, it's considered unearned income.
Okay, and I think this is going to be our last question because we are at time. The question that I'd asked the person to give us some more information, it says, I don't have tuition in excess of scholarship, just tuition exactly equal to scholarship. But I'm wondering if I'm allowed to count part of my scholarship as income instead of as scholarship so that it can take advantage of the lifetime learning credit and just pay the marginal tax on that scholarship as income?
Yeah, that can be done. Yes, absolutely. You can, if you want to pay taxes on some portion of that qualified educational expense and then take advantage of the tax credit. That's a possibility, yes.
Okay.
Obviously, you want to compare what's going to provide you with the greater tax savings.
Okay. All right. Great. Thanks, Bob. That's been really helpful. I
Sure.
think that's all for today. We're at time. Bob, thank you so much, as always, for coming and helping us understand how to file our taxes. This is a really confusing thing for most people. So thank you very much.
Well, I hope I answered everyone's question. And again, as I've said time in and time again, if something comes up after the presentation and you want to shoot me an email, feel free. Be more than happy to help you out as best I can.
Thanks so much.